Everything you have been told about retirement safety is a lie. The 4% rule? It's a fairy tale, a mathematical ghost story told by advisors who haven't updated their spreadsheets since 1998. If you have $500,000 or even $2 million saved, you think you're safe. You think the math works. But there is a silent wealth killer lurking in your portfolio right now. It is not a market crash. It is not a recession. It is a mathematical anomaly that turns safe portfolios into zero in less than 10 years. And your financial advisor isn't warning you about it because they don't understand the math either. Today, we aren't guessing. We are going to break open the engine of the market and look at the gears. By the end of this video, you will see the trap. But more importantly, I'm going to show you how to dismantle it. Let's start with the sacred cow of retirement planning, the 4% rule. The idea is simple. You have $1 million. You withdraw $40,000 a year, adjust for inflation, and you'll never run out of money. Wrong. Here is the problem. That rule was created using data from a specific period in history where the U.S. economy was a rocket ship. It assumes average returns. But you do not live in average. You live in reality. And in reality, averages are used to hide the bodies. Think of it this way. If you try to cross a river that is on average 3 feet deep, you can still drown in the 10-foot hole in the middle. The stock market has 10-foot holes. If you hit one of those holes early in your retirement, the 4% rule doesn't just fail. It guarantees you go bankrupt while you are still alive to see it. This is the first twist. The math of accumulation, growing your wealth, is totally different from the math of decumulation, spending it. When you are saving, volatility is your friend. When you are spending, volatility is your executioner. Let me introduce you to the monster. Wall Street calls it sequence of returns risk. I call it the timing trap. This is the mechanic that destroys portfolios even when the market looks healthy on paper. Let's look at a hypothetical scenario. Investor A and Investor B both retire with $1 million. They both withdraw $50,000 a year to live on. And over 20 years, they both get the exact same average return, 6%. Same starting money, same withdrawals, same average return. Logic dictates they should have the same bank balance at the end, right? Wrong. Investor A gets the bull market first. Their returns are positive in the early years. Their portfolio grows so fast that the withdrawals don't hurt them. Even with the spending, the compound interest outpaces the cash outflow. They end up with $2.5 million left over. But Investor B, they get a market crash in the first 2 years. Just when they start taking money out, the portfolio drops. They are forced to sell assets while they are down. They cannibalize their own principal. Because they sold at the bottom to pay the bills, those assets are gone forever. They can't recover when the market finally bounces back. Investor B runs out of money in year 13. Zero. Bankrupt. Look at me. This is the twist that keeps me up at night. The market doesn't care about your average. It cares when you lose. If you retire into a bear market and you are following the standard advice, you are mathematically doomed before you even unpack your golf clubs. Okay, you say, I get it. Stocks are risky. I'll just put 60% of my money in safe, boring bonds, treasury bills, the bedrock of finance. Welcome to plot twist number 3, the bond illusion. For 40 years, bonds were the safety net. Because for 40 years, interest rates went down. When rates go down, bond prices go up. It was a golden era. But we have entered a new cycle. When interest rates rise, the value of the bonds you already own collapses. If you are relying on bonds to be your shield against a stock market crash, you are fighting a modern war with a musket. In an inflationary environment, bonds and stocks can fall at the same time. There is nowhere to hide. And while the market fights you on the front lines, there are 2 snipers behind you, inflation, and taxes. Sequence of returns: risk kills your principal. Inflation kills your purchasing power. Taxes kill your efficiency. It is a pincer movement designed to crush the unprepared. You plan for 3% inflation. But what if it spikes to 5 or 8% for a few years? Your expenses don't just go up linearly, they compound. In year 1, your grocery cart is full. By year 10, for the same price, it is half empty. And remember that 401k or IRA is a ticking tax bomb. Every dollar you pull out is taxed as ordinary income. If tax rates go up in the future, which, looking at the national debt, is a mathematical certainty, your safe withdrawal rate shrinks even further. Okay, take a breath. I didn't tell you this to scare you. I told you this so you can survive it. How do we beat the math? We stop acting like victims of the market and start acting like strategists. First, the cash buffer. You do not sell stocks when the market is down. You survive on a war chest, 2 to 3 years of living expenses kept in pure cash or cash equivalents. When the market crashes, you stop selling stocks immediately. You burn the cash buffer instead. You give your portfolio time to recover. You bridge the gap so you never have to sell at the bottom. Second, dynamic spending. Forget the rigid 4% rule. If the market drops 20%, you tighten your belt and withdraw less. If the market roars, you give yourself a raise. Flexible trees survive the storm. Rigid oaks snap. But there is a missing piece. A cash buffer is great. Dynamic spending is smart. But neither of them actually grows your wealth while hedging against a crash. They are defensive moves, not offensive ones. There is one asset class that mathematically solves the sequence of returns risk. It is not stocks. It is not bonds. It is not real estate. It is the only asset that actually benefits when the rest of the world is panicking. Next time, I'm going to show you exactly what it is and how the ultra-wealthy use it to make volatility profitable. Do not rely on luck. Rely on math. See you in the next one. This content is for educational purposes only and does not constitute financial advice. Consult with a certified financial planner before making any investment decisions.